Last week, we saw the markets close at fresh record highs, something we've also seen again this week, where it's noted that the fear of missing out by investors is making them want to continue to buy, even at what is called the stage right now of the dot-com on steroids. And what makes it worse is that valuations today are significantly higher, and things at that point in time did not end too well. We're also noticing pretty much across a lot of industries, companies continue to see their share price climb. We're getting quite a lot of growth in the software space. We have CrowdStrike up 15%, Synopsys up around 16%, as well as a few others. And if we look at other industries, Google, Meta also continuing to climb. Tesla again, last week it was up double digit, this week up around 8%. With many investors still very jubilant, still as highlighted with FOMO continuing to buy, and we're still surprisingly not in extreme greed just yet, but we're still sitting firmly in greed. Now today's episode is incredibly important because when we look at the data, this is for a 20-year period, but you go back as far as you want, the conclusion remains the same. The average investor massively underperforms if they had just put that money into the S&P. So if we go back from 2001 to 2020, you'd be up 7.5% on an annualized basis. The average investor 2.9%, and with valuations very high, whether you look at a forward P or a price to earnings growth, we need to understand which companies should we think about trimming and where does the opportunities lie. Now, typically on the channel, we take a look at companies where there is undervaluation, where we can see some very strong upside. For example, if we look at ELV, in isolation, the forward P of 10 sits below the 5-year of 14. You're also getting yield of 2.2 above the 5-year of 1.2. And in combination with the blue tunnel, where we see right now the trading price below even the bottom end, undervaluation is possible and it would make us want to do a deeper dive. Remember, the blue tunnel in fact does highlight the expected price. Disparity here does mean potential opportunity. Again, we look at many companies. You can also see the same, for example, Novo Nordisk, where we did a deeper dive yesterday. 16 forward P below the average of 30, yield 2.8 above 1.4, and the same again, although to a much larger degree, massive disparity, so potential opportunity. Today's episode though, as we said, very important. We're looking at the opposite. What companies are now trading very high for their growth and the valuation looking a bit absurd. We're going to run through 8, including number 1 Starbucks, running through their valuation, their growth, and ultimately our own intrinsic price. Starbucks, we really wanted to bring this to the front because we do get a sell rating very rare, with the only buy rating being from Wall Street 3.65 out of 5. Is also one we covered not that long ago as a sell, and we can see right now the price is even lower, something we do believe is still overvalued. In the last year, they're down 13%. Year to date, they're down 7%. And over the last 10 years, well, they've massively underperformed the S&P. If you want to see their all-time high, you'd have to go back now more than 4 years ago at $126. And even though it is trading near its 52-week low, it is one that we, like Seeking Alpha, do not believe is a buy and at the very most a potential hold. Unlike the first two companies we highlighted very briefly as potentially undervalued, forward P 34 above the 5-year of 29, this is what we would say potential overvaluation, although it should be noted you are getting yield of 2.9 above the 5-year of 2.2, but the dividend safety score not looking great at a 60 borderline save. The blue tunnel also highlighting the opposite disparity at the upper end. Current value sits above the blue tunnel, and that in itself is another overvaluation signal, something we've seen for quite some time in the last 12 months. And actually, when we zoom out to the last 5 years, not great to see the intrinsic value, bit of a yo-yo up and down. Ideally, we want to see this moving upwards over the longer term. And if we look at their valuation at a C-, not great. Forward P 39, not only above the sector of 18, so you're paying a 113% premium, but as we just highlighted, above their 5-year, you're paying a 21% to their own average. If we also look at the price to earnings growth on a forward basis, 11.5, well above the sector. You're paying a 556% premium. Against their own 5-year, you're paying a 313. Clearly not justified. Their growth at D-, flat year on year. If you incorporate inflation in real terms, that is a decrease, lower than both sector and their historical 5-year average. Yes, 3%, not the greatest. Moving forwards expectations, pretty much in line with the sector, but historically Starbucks was growing at a much faster rate. The other thing, which maybe is the most disappointing, earnings per share projection over the next 3 to 5 years, only 3% when the sector sits at 11 and their own historical much higher at 14. Now, as we said, each one of these 8, we're going to give you our own intrinsic price, which today for Starbucks gets to just under $75. When we do a deeper dive, we run through every single one of these models, talking inputs and outputs. We want to get straight to it today. The only addition we will do is if you want to look solely on DCF, we get to $77, a little bit higher. And what this is really highlighting is baked into the price solely on a DCF is 8.2% growth to the future free cash flow year on year. Again, the information is there if you want. And whilst we typically like to kick things off with a 10% margin of safety, where we execute by if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data, well, that would be at $67, really highlighting, as of today, if you're buying, you are paying a 13% premium. There is no margin of safety. We'll highlight, though, if you want to make a note, at 10%, a buy potentially at $67, at 20%, a buy at $60, and at 25%, a buy at $56. Wall Street, however, are in disagreement. Even with their very weak buy rating, they see this at $100 into next year, 19% upside. But do let us know, maybe you agree, maybe you disagree. Stock number 1, Starbucks, do you see it as a buy, hold, or avoid? Before we move on to the next stock, just to let you know, we have released our latest free weekly article. We drop one every single Monday morning to your inbox, covering severely undervalued stocks, as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Walmart, up 31% over the last year. We'll just highlight there was some consideration of adding Costco as well, although it has been coming down nearer and nearer to its 52-week low, and it's also due to report in the coming week, so it is one we can do a further look after their earnings. Year to date though, Walmart up 13%. Over the last 10 years, this one has, unlike the previous company, outperformed the S&P, trading very near to its 52-week high, and one strong buy rating from Wall Street and a double hold from Seeking Alpha and Quant. In fact, Seeking Alpha very near the 2.5 that we did see with stock number 1, where it did get that sell rating. Now, forward P ludicrously high at 37, their 5-year average well below at 25, yield on offer 0.9% versus historical 1.5, and we also get that disparity on the upper end. In fact, from the beginning of the last 12-month period, it has only been getting larger and larger. This one does look, at least for the time being, getting a little bit out of hand. And actually, if we zoom out to the last 5 years, this one for quite some time, around 2021 to the midpoint of 2024, was trading in a reasonable signal. It looks like, though, over the last 18 months, this one has in fact been trading at such a huge and, in my opinion, unwarranted premium. Now, valuation at an F, highlighting here, you're paying a 141% premium to the overall sector, a 46% premium to their 5-year average, and on a price to earnings growth basis, well, in fact, an 83% premium to the sector and 35% to their own historical. Growth also, again, highlighting not warranted for the price you're paying, 4% in line with inflation year on year, expected the same this year. Yes, it is above the sector and in line with their 5-year, but this, in my opinion, is not something, as we said, is justified for the price investors have to pay today. 8% EPS expected, above the sector at 6%, and pretty much again in line like their revenue with their 5-year average. Now, our intrinsic value at $87, in fact highlighting here based on a DCF lower at 68 And actually, we really wanted to pinpoint this out today because we've used something that you could argue very generous at 15% growth. And the main key takeaway here is baked into the DCF is 20.3% growth year on year. Again, really highlighting this one does look to be out of hand, where you're adding right now today in what we believe is a 17% premium. Again, if you wanted to make a note, at 10%, a buy at 78, at 20%, a buy at 70, and at 25, a buy at $65. Wall Street with a strong buy rating see this climbing higher, $115, 13% upside, but let us know your thoughts on Walmart. The next one is American Express, a very strong company. Over the last year, up 27%, year to date up 15%, another outperform of the S&P, pretty much trading very near to its all-time high, but a triple hold rating right across the board, where we notice forward P 21 above the 5-year of 18, yield 1% below the 5-year 1.2, and is also one that is, however, very slightly outside of the blue tunnel. You could have bought this severe undervaluation around Liberation Day. As always, make sure you're subscribed, notification bell is on. We will let you know when companies of high qualities become severely underpriced. And actually, if we zoom out to the last 5 years, there have been some opportunities to buy this company in those exact situations. Valuation at an F, you're paying a 95% premium to the sector, 17% premium to their own 5-year. Incorporating growth, 60% premium to the sector, and another premium, 22% to their own historical. Growth looking okay, we get a B here, 9% last year, 9% again expected this year, a little bit below their own 5-year, so no real efficiencies, not something we're too pleased about. That is ultimately what we want to see from high quality companies. 12% EPS, above only slightly the sector at 11, but massively below their own 5-year of 21%. So why would you buy AXP when in fact they're growing slower than they have done, both revenue and earnings per share in the last 5 years, but they're trading at quite a hefty premium. Now, our intrinsic price, $325, not too dissimilar from the DCF, again, if you just wanted to make note, where it is baked in 4.2% year on year. As of today, though, we see a 5% premium being applied to the price if you're adding. At a 10% MOS, though, a buy at 292, at 20%, a buy at 260, and at 25, around the 243 mark. Wall Street actually the first one today where they see this lower than the price today in the next 12 months, 334, downside of -2%. Let us know they also did have this as a hold, so maybe that is where you see American Express today. We then move on to Lam Research, huge performance in the last year, up 61%, year to date up 76%. This is one that we did cover on the channel where it was around the 52-week low. We did like this one quite a lot, but as of today, trading right there at pretty much a all-time high. It does look severely overvalued, and we get in fact a double buy from Seeking Alpha and Wall Street. We get a forward P 29 versus the 5-year of 21, yield a little bit lower, 0.8 versus 1.1, and quite a bit of disparity between the current trading price and the upper end. This one again in severe overvaluation, very similar to Walmart, but actually over the last 5 years, again, there were some opportunities for investors to buy the dip, essentially where it was below the bottom end. Now, valuation at an F, you're paying a 13% premium to the sector, 38% premium to their own 5-year, and if we do incorporate growth, pretty much in line as we can see against the sector, but actually more interestingly, they typically do trade at a higher PEG ratio, and you are getting a 13% discount. But is it warranted for the growth? We get a C-, 24% year on year, 14% in fact expected this year. Bear in mind the industry is cyclical, hence the large movements. Above though on both accounts against the sector and their own 5-year average. Earnings per share though, probably what does let this down overall, 15%, in line with the sector and only marginally higher than their historical 13.2. Now, our intrinsic value, $119, actually interestingly reflects a higher DCF of 138, where baked in is around 8.9%, but we are using all 4 models, and that in turn gives rise to a 7% premium. More interestingly, Wall Street believe this run is not justified. They see this $114 into next year, 10% downside. And again, if you wanted to make a note, 107 buy at 10% MOS, at 20% a buy at 95, and at 25% a buy at $89. Lamb Research, do let us know. We then move on to the tobacco industry, Altru Group. Although in the previous episode we did cover British American Tobacco, which is lower than what we did talk about earlier, so just goes to show these are ones that we do believe will continue to decline, and we could have also used both of these companies interchangeably today. It's up 29% in the last year, up 24% year to date. Over the last 10, massive underperformance, up only 18. Is trading very near 52-week high of $68.60 with only one very weak buy rating from Seeking Alpha, and we see a forward PE 12. In fact, that is the highest in the last 5 years against the average of 9.4. Yield of 6.5, again one of the lowest in the last 5 years against the average at 8, and no surprises here, disparity between the 2 points, one that pretty much started from around March this year, and that is why we would say definitely one to consider in the portfolio, maybe trim it or in fact sell, as ultimately the point of this exercise is to really highlight these companies have outgrown the realistic expectation and there are many other better opportunities. Now their valuation actually gets an A, something we haven't seen today, and you are getting a 27% discount to the sector, but actually a 22% premium to their own 5-year. They're also trading 8% premium on a PEG ratio against the sector, a 33% premium against their own 5-year, and you're probably not surprised to note for the tobacco industry, growth sitting at a D. No growth last year, none expected again this year. That is below the sector, also lower than what they have done historically. So not only is it in fact no movement, but also incorporating inflation, real terms, a decline. Earnings per share 4% below sector at 6, pretty much in line with their 5-year at 4.6, and our intrinsic value at $61, DCF a lot lower at 56, highlighting baked in is pretty much no growth. We have gone negative 2%, that is in fact some would argue a little bit optimistic. Again, the industry they're not expecting that much growth, at least for Altru Group, maybe not something we noticed for companies like Philip Morris in this space. But regardless, we notice overall a 6% premium if you're adding today, 10% MOS, a buy at 55, at 20% a buy at 49, and at 25 a buy at $46. Wall Street also see this 6% lower into next year, $61 target. Do let us know whether you see MO as a buy, hold or avoid, and the same that we have run through like in the previous episode applies to BTI. We then move on to the Home Depot, up 6% in the last year, up 7% year to date. Over the last 10, it has outperformed the S&P, trading near 52-week highs. Just one buy rating today from Wall Street, where we notice a forward P around the 26-27 mark is above the 5-year of 23, yield a little bit lower, 2.2 versus 2.4, as well as an overvaluation signal, something we have seen sporadically in the last 12 months, but in fact over the last 5 years there were opportunities to buy this undervalued. Now valuation grading at a D, you're paying a 53% premium to the sector, 24% premium to their own averages, and if we incorporate growth, 213% to the sector, 50% to their own 5-year, and growth very lackluster, D-, 9% last year, expected this year in line with inflation at 4. We do notice the sector a little bit lower and their own 5-year also not too different. Earnings per share though, massive letdown, only 5% expected. Sector's actually quite high at 11 and their own 5-year also above 7.6. Now intrinsic value $400, where in fact the DCF coming at 413, highlighting on a reverse basis 8.1% growth, means right now we see this trading at a 4% premium, at a 10% MOS, a buy at 360, at 20% a buy at 320, and at 25 noted a buy on the $300 mark. Wall Street themselves, yes, they do see upside of 8%, not that much, $448 price target. There are many other better opportunities, but again, maybe you agree, maybe you disagree. Do let us know on the Home Depot. We then move on to Nike, which is down 12% in the last year. Year to date, down 6%. Over the last 10, it is up only 13%. Another one we covered not that long ago as a sell, and it is now lower, which we do expect to continue, trading around the mid to lower end of the 52-week range. Just 1 week buy rating from Wall Street, where we see a forward P 42, well above the 5-year of 33. In isolation, looking incredibly high, yield of 2.3, well above the 5-year at 1.2. And just to highlight the disparity, the dividend does look to be safe at 80. And on the blue tunnel, not only do we see it overvalued given the disparity up top, but also the intrinsic expected price has been decreasing, not a sign, as we said, you want to see from any company you're holding, and actually a bit of a downward trend when we do zoom out over the last 5 years. Valuation, no surprises, at a D-, 137% premium to the sector, 22% to their 5-year average, and if we look on a PG, 33% premium, actually a 45% discount, although in isolation a PG historically at 4.2 does look very, very high for the company, and this is really where the disappointment comes in a massive wave. C- on the growth, negative 10% last year, expecting negative 2 this year. No surprises when you look at it against the sector and their own 5-year average, it is much lower. In fact, comparisons are positive. Earnings per share, though, is anticipated to be high at 18 to 19, well above the sector at 11 and their own historical 12.4, but does depend on whether you believe management can execute. And our intrinsic value, $58, where we note DCF actually not too dissimilar, is derived using a reverse 10.2% growth to the future free cash flow year on year, and probably the largest premium we've noted today, 23%. If you wanted this as a buy at 10%, in fact $52, at 20%, $46, and at 25 we note $43. Wall Street themselves, though, in disagreement, see this at $82 into next year, upside of 15%. Let us know if you believe it is a buy, hold, or avoid. We then move on to the Hershey Company, down 3% in the last year, year to date up 12%. Over the last 10, this has massively underperformed. You probably would have been a very good timer of the market if you sold the top, we're talking over 2 years ago, $275, trading not too far off 52-week high, 208, with a triple hold right across the board, both seeking alpha and quant not too far off a sell rating, and a very high forward P, 33 versus historical 25, although the yield is above 2.9 versus 2.1, and good to see dividend looks to be safe at an 80 score, where we do see the blue tunnel decreasing. Remember, not a good sign with the expected price sitting above, something if we zoom out to the last 5 years did start to dip from around 2024, although some reason of this was related to the high cocoa prices, something that hopefully as it does start to decrease will help them with their margins. Now D on the valuation, 97% premium on a forward P to the SEC, 31 to their own 5-year, where growth looks terrible. We're talking an F, 2 to 3% year on year expected this year, which whilst is pretty much in line with what we're seeing from the sector, is lower than their own 5-year, around the mid-single digit. Earnings per share, this is the real kicker. They're not expecting any growth over the next 5 years, when historically the sector and their own 5-year comes in around the 6% mark. Now intrinsic price, $175, actually notes a slightly higher DCF value of $205, baked in around 5%, but overall still we see this trading at an 8% premium. 10% MOS, well, a buy at 157, at 20% we're talking 140, and at 25 around 131. Wall Street themselves, we do note 1% upside, $190, just $1 per share, but give us your thoughts whether you agree or disagree with any of the stocks today, and if you see them as a buy, hold, or avoid. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.